Hi and welcome back to another video. In this video, we're going to be analysing CrowdStrike. They are a growing leader in cloud cybersecurity. The company has a great business model and a history of outstanding execution. The stock is priced for aggressive growth, but going by their current metrics and recent successes, there is room for this growth in the years ahead to make up for the price. We're going to do our best to understand the business and why it's so special, although cybersecurity software really isn't my strong point. Ideally, we want to have complete confidence in the company's ability to execute, to grow, and at least go above the expectations of the stock at the moment. As usual, we will try our best to put this into realistic numbers and then estimate a fair value to buy CrowdStrike stock today. CrowdStrike was ran in a poll earlier this week to see what was the next video to analyse on the channel on our Patreon page, and it won by a very close margin, so that is why we are looking at it today. So let's look at the business model and why it's so successful. If we start from the top, I will let George Kurtz, founder and CEO of CrowdStrike, explain the fundamentals of what they do and why.
I'm George Kurtz, CEO of CrowdStrike, a leading cybersecurity company. Organizations around the world have told us how frustrated they are with their security solutions, how difficult they are to install and keep updated, and how ineffective they are at stopping attacks. At CrowdStrike, we found a new way forward. We built a security platform powered by artificial intelligence and delivered from the cloud, protecting computers and servers against sophisticated data theft and ransomware. It's fast, easy to manage, and it actually works.
We're a high-profile team with a very high-profile brand. We take our security very seriously.
I don't need to be a cybersecurity expert. Having a company like CrowdStrike, knowing that we're protected.
CrowdStrike doesn't drop the technology and walk away. CrowdStrike is embedded within your organization. They understand the deployment, and they're watching your back. That's what technology is supposed to do for you.
CrowdStrike, headquartered in Sunnyvale, California, helping enterprise to small businesses stop breaches globally.
So they have a disruptive business model in endpoint security. They compare themselves to the likes of Salesforce for CRM and Workday for HR in terms of how they're disruptive because of their cloud-based solutions versus the legacy providers. The reason why it's disruptive is because it's a cloud-native platform, which they call Falcon. Falcon uses artificial intelligence to learn from the data it collects, and this in turn means that they are permanently improving the effectiveness of the platform to provide the best solutions in an ever-changing cybersecurity environment. When a client gets attacked, the company gathers information from that attack and then learns from it, generating better solutions for all of CrowdStrike's clients based on one single event experienced by one client. So in a sense, CrowdStrike and its clients are benefiting from the network effect, which means that the value of the platform increases as it grows in size. The more users CrowdStrike has, the more information it collects from those users, which makes the platform more effective for all of the users. This creates a self-sustaining virtuous cycle of consistent growth and enlarged competitive strength for CrowdStrike over time. And without going into too much detail and confusing myself, let alone any of you guys, the one downside from an investor's point of view, so not really a downside from the business model, is that it is very difficult to understand. It's not one of these easy businesses to get to grips with. So you have to be comfortable with that. What I will say is that it's very easy to see on the face of it why their business model works and is disruptive, because it's focused around the experience of the end user. So from an investor's perspective, this is what makes the business model so special. You've got that reoccurring revenue. As with all of these cloud and SaaS platforms, you have this subscription revenue, which ultimately, if the product is good, means that revenue will compound year over year with ease as new customers come in and existing customers stay, causing that compound effect. They've now got 92% of their revenue, which is subscription revenue, annual recurring revenue growing at 75%. And then we've now got 9,896 subscription customers. So they're getting a big customer base now. And this page here gives us a really good idea of, I guess, how effective their product is in retaining customers. So we can see really high in terms of just percentage customers that stayed with CrowdStrike, and that's up at 98% now. But when we actually look at the dollar retention in terms of how much did we retain in terms of how much those customers spent with us year over year, it's up at 125%. So that's telling us not only are all of their customers staying with them because they offer the best service, they're actually spending more with them year over year. And I think this gives us a good idea of how good their product is compared to the rest of the market. Another indicator, the majority of subscription customers have multiple modules with CrowdStrike as well, so they want to use them for more than one thing. And lastly, another good indicator is the customer base, or the profile of the customer base. Not only are they growing customers rapidly, but it's the type of customers that they're attracting, which says a lot about the business and the product that they offer. 58% of the Fortune 100 use CrowdStrike. 177 of the Fortune 500 use CrowdStrike. And you've got 12 of the top 20 banks who use CrowdStrike, who are going to be very heavily focused on adopting the best security platform out there. And just to touch on the financials before we start getting into our valuation, we can see their rapid growth, not just year over year, but this is actually showing quarter over quarter. We can see consistent growth every single quarter. And the majority of it, again, is that annual recurring revenue. They're now up to $1 billion in revenue when looking back on the trailing 12 months, which is 75% growth from the quarter a year ago today. The annual revenue growth is really strong, almost doubling every single year, as you can see, 249 to 481, up to 874. And now by, I think, they must be in the second or third quarter of their financial year, they're already over $1 billion. So they're almost doubling every single year, which is really impressive to see. And it is boosted by that reoccurring subscription model, which just provides a platform for compounding and for that growth, especially if you're retaining 98% of your customers and over 120% in terms of dollar amount retained. And what this is doing as they benefit from this virtuous cycle is their margins are improving quite rapidly. We can see they're already up to 80% gross margins in terms of their subscription revenue, which is a really high gross margin. You know I like gross margins, leaves a lot of room on the bottom line for profit. And it looks like they're getting to profitability even quicker than they expected initially. And as demonstrated here, the operating leverage is getting a lot better. We can see sales and marketing at the moment making up the largest expense, 37% as of the most recent quarter, and then the most recent year, 40%, R&D only making up just about 20%, and then G&A, which is very nice to see, making up a tiny 8% of revenue. They managed to actually get a 13% operating margin in the most recent quarter, which is positive to see, considering their long-term target for our operating model is around 20% plus. So they're already close to hitting that. And you can see the rest of their costs or operating margin targets. Sales and marketing, they actually want to keep quite high at 30 to 35% of revenue, but I could see this dropping off slightly as the company gets bigger. It could probably be even more profitable than the 20% that they're pushing out here, especially with 80% gross margins to work with. One of the biggest positives, apart from the impressive business model and the superior product that they have, is the TAM potential. So we can see here that it's expected, I think from IDC, who have done this report, that cloud security spending from organizations is going to at least double between 2020 and 2023, going from 6 billion up to 12 billion, which is impressive growth. CrowdStrike give us some guidance here on what they think their total addressable market is, made up of all of these different areas, and it's currently at 36.5 billion. They think in 2 years there could be a 9% compound annual growth rate in that dollar amount, and gets us up to 43.6 billion total addressable market in 2023. So they're a very small capture of that now, which we like to see. It's always good to consider picking up a company that has this sort of disruptive business model, has a superior product in a large and growing total addressable market, because if they really do have the best product out there, it is only natural they will start to eat into that total addressable market and pick up a fairly large market share. So that probably makes a good time to talk about the current price or current valuation for CrowdStrike. So although they are a very small capture of the total addressable market, which is 43 billion in terms of their revenue, they've only got to about $1 billion on a trailing 12 months basis. Their market cap already equals that 2023 TAM. So this stock is priced at a premium, like I said, selling at a forward PE of 329 times. You've got a price to sale of essentially 50 times, which is expensive. The growth estimates, at least for the next year, are pretty hefty, with 100% plus next quarter and next year, dropping to 25% in the next 5 years, though, which I think is a little bit of a lax estimate, if you ask me. I don't see them achieving a growth rate that low, especially not in terms of earnings that are only just coming into fruition with that operating leverage that they have. But we're going to package all this information into our valuation come up with what we think's a fair growth rate, a fair margin profile for the business, and then we can estimate what a fair price would be to buy CrowdStrike today if you are interested. Okay, and I'll talk you through the valuation quickly before I give you the price target. So you can see here their historical results in a little bit more clearer format. So you can see how impressive the growth has been. The 5-year forecast period, I'll give you the thesis on that. So their current growth rate is 77% year over year as of the most recent quarter. So I'm taking that current growth rate and I'm just going to trail it down over the next 5 years. Analysts have them in for 100% growth in 2021 to 2022, but I'm not going to be that bullish on it. I think it will trail down. It's not going to be 100% year over year for the next 5 years like it has been in the future, just because of the law of large numbers, and they really will eat into that total addressable market. So speaking of that total addressable market, it's a 2023 TAM, but it would be 15 to 20% market share that CrowdStrike would have if they can get to this revenue number of 7.6 billion in 2025. As for earnings, well, they're currently at a 10% margin. As we looked at free cash flow, they are free cash flow generative with 33% margins. And the main reason for the discrepancy here is the stock-based compensation, which doesn't touch the cash flow as it's a non-cash expense, but it does eat into the bottom line, especially on a GAAP basis, so makes the margins look smaller. I've got them trailing up to 25% over the next 5 years from where they are now. Their long-term target was 20% plus, so they were a little bit vague there. I think they can overachieve this pretty easily, especially with the 80% gross margins that they're working with. Free cash flow, I've really just got mirroring that, even though it's higher than that in reality at the moment, but I don't want to go over and beyond with this at the moment. Cash, they've got a lot of cash, nearly 2 billion, a little bit of debt as well, but I think they have got a self-sustaining business model with those reoccurring revenues, so I don't expect them to raise much more debt throughout the next 5 years. Cash is probably going to grow as they're becoming profitable. Naturally, that happens. And we start to see a trend with the shareholder equity start to build up as well, which shows us that efficiency in growth. For my terminal values, I've got a few here, but the only ones that we're actually going to be using are the EV to sales multiple and an EV to EBIT, or times operating income. I've gone with 12 times for the EV to sales multiple, just using Fortinet as an example, which is one of the more established or mature players in the market. They've got an 11 times price to sales multiple. And some of the other legacy players actually have even higher multiples with lower growth rates, and some of them have lower ones. But I thought anywhere between 10 and 15 would be a fair multiple to go with, especially with the 80% gross margins that they have. My EV to EBIT, or times operating income, I basically just wanted a multiple that mirrored the growth rate. It's actually because there's a margin expansion here, it's going to be below the growth rate. So this means that the PEG ratio would be below 1, which usually means that you're giving yourself a conservative multiple estimate. And that's where the thesis came for both of them. The perpetual growth method, which is a 4% growth rate into infinity, I just put in there so you could see how close it was relative to these two, and it pretty much mirrors the EV to EBIT multiple. So we're going to average these two out here, and that gives us an enterprise value in 2025 of 86 billion for CrowdStrike. We less the debt and plus the cash, and that gives us a market cap of 88 billion, and then a target price in 2025 of $403 per share, which equals just over a 2x return in 5 years. Now, if we discount that back at the proper discount rate, which on this channel is 15%, and for me 15%, because that is my minimum required rate of return. I won't accept a return of less than that. That gives us an intrinsic value for CrowdStrike today of $40 billion US dollars, and a share price or price target to buy the stock at $186 per share. So we're currently 4 to 5% overvalued with no margin of safety, which isn't too bad. We're pretty close to the stock price today, which is good to see. If we take a look at CrowdStrike stock, we can see that it's floated around this price for a good few months now. It actually dipped below our target price back on the 8th of March with the tech dip. So there is the possibility that it will creep back down to where our price target is. And I will say you may well get a higher intrinsic value and price target if you were to stretch this out to a 10-year forecast period. But for visibility and conviction reasons, I thought it'd be best to keep to a 5-year. What I will do though is I will make a 10-year scenario just trailing down that growth rate, and I'll post it on Patreon. I'll keep the link on Patreon for anyone who wants to see that, to get a second view of how well priced the stock is or what sort of fair value you could get the stock for today. And that's it for this video, guys. I hope you all enjoyed it. CrowdStrike seems like a very compelling company with a great business model and tons of growth potential. Personally, I won't be investing, at least right now, not just because of the price and a lot of growth being accounted for already, but because it's a difficult business for me to understand overnight and really have a high conviction that no competitors could set up a SaaS business model like this and then threaten CrowdStrike. I'll leave that for you to all advise me in the comments below if you are an expert in this field. And in the meantime, I will do some further digging into CrowdStrike and the cloud cybersecurity market to get a better idea and understanding of if this makes a very good long-term investment. I'd appreciate if you could leave a like if you enjoyed the video, and if you haven't already, subscribe to the channel for more videos and analysis like this. Thank you all for watching. I will see you in the next one.